Good morning, everybody. Thank you for joining us today. Auto enrolment is a complicated business. There's a lot for us to cover today, but I thought it would be useful as a starting point just to remind you about what are the key requirements of the legislation, what are employers required to do. So as a starting point, actually, who do you have to look to include? So it is all of your employees, everybody on your payroll, but there are some exemptions for individuals with pension protections. Directors do need to be included, but not non-executive directors. And these are individuals aged over 22, but also under state pension age, earning over £10,000 per year. And also, quite importantly, they need to not already be in a qualifying workplace pension scheme. So when do you do this? So you do this when they start with you, day one of joining service, or you could look to use postponement, which enables you to start the assessment and enrolment a little later, or when they attain age 22, or when their earnings exceed that threshold already mentioned. Quite importantly, if employees are not eligible to join, then they do have the right to join the pension scheme. So employees do need to make sure that they're enabling this for their employees. So just covering over all of that, I'll now hand over to Kim, who will discuss some of the legal aspects for you.
Good morning, everyone. You brave people wanting to know about pensions on a Friday before your weekend. So what I'm going to cover today is firstly the Pensions Regulator and the Pensions Ombudsman and where they come in with regards to automatic enrolment. As you'll see, Caroline has highlighted quite a few areas that you need to consider with regards to automatic enrolment. What we're seeing a lot on the legal side is since 2012, more and more individuals and pension providers are actually going to the Pensions Regulator and the Pensions Ombudsman. So where does the Pensions Regulator become involved? Well, firstly, they're doing regional spot checks, compliance. They've been focusing on various sectors, such as the care sector, the charity sector. More recently, at the beginning of this year, they're actually focusing on the larger employers and do spot checks to make sure that they're compliant. If they uncover anything where you're not compliant, then you could be subject to possible fines, which I'll come on to in a moment. You may, if you've reached automatic enrolment, an employee could blow you to the Pensions Regulator, and again they'll undertake a check and there may be some potential fines. You may also, if you've incorrectly undertaken automatic enrolment and the pension provider becomes aware as well, they will send you a letter letting you know that they may be looking to whistleblow you to the Pensions Regulator. So the enforcement that the Pensions Regulator have got, they've used in the last few months, at the beginning of this year, they've used their enforcement powers 35,000 times. In terms of the fines that employers are looking at, if they fail to comply with automatic enrolment, there's a fixed penalty of around £400, but then there's also an escalating penalty that can range from £50 to £10,000. To put this into perspective, the largest fine that I've seen from the Pensions Regulator was in the region of £50,000. And that was simply because the employer had failed to submit their declaration of compliance to the Pensions Regulator, and had also ignored some correspondence from the regulator requesting that they rectify it. In the Pensions Ombudsman, now we're seeing more and more cases that are going to the Pensions Ombudsman where employees are whistleblowing their employer for failing to comply with automatic enrolment. A lot of these seem to be small amounts of pension that they've lost, but actually some of the fines that are being imposed are anything from the region to £500 to £2,000. But if you go to the Pension Ombudsman, like I'm assuming, it can take a few years to deal with. So we recommend that you deal with any breaches as soon as possible. The other downside about if you are reported to the Pensions Regulator or the Pensions Ombudsman, you will be named and shamed. In the Pensions Regulator, they do a quarterly report, which it highlights all the employers that have breached automatic enrolment, and the Pension Ombudsman publishes all of its determinations on its web, and again, both of which are visible by the public. So just where I'm seeing where employers are getting it wrong, and just to, again, to put this into perspective, I've been advising on automatic enrolment since the beginning, and it is incredibly complicated. I think it's fair to say that I'm probably seeing around 75% of employers have actually got it wrong. A lot of them don't know they've got it wrong. So some of the things that I'm seeing where employers are getting it wrong, like I've mentioned previously, late submission of the declaration of compliance, failure to submit the re-declaration of compliance within the statutory timescales, pension contributions, employers having deducted the correct amount of pension contributions, or they've just done it on the wrong basis. Employers haven't assessed their casual workers to see job holders, payroll issues, which Caroline will touch on. I haven't seen many employers that have willfully non-complied with automatic enrolment. I've only seen one so far. Also, non-qualifying pension arrangement. This comes up quite a lot. We have a number of employers whereby they have a pension scheme in place prior to automatic enrolment, which wouldn't have been a qualifying pension scheme. Continue to use that, and it's non-qualifying, and that's a breach of automatic enrolment. I also see where employers have got it wrong, where they've got an individual who may have been age 21 when they reached their staging date, but then had a birthday, turned 22, and the employers failed to automatic enrol them. Fluctuations in salary, again, this is for individuals that were earning below 10,000. And then we see this a lot in the hospitality industry, where people are seasoned workers and there's a peak in their salary because they're taking on more hours, and then they end up becoming an eligible job holder, but they're not picked up by the employer. The one thing we do see here a lot is that sometimes as an employer, you need to make sure that your payroll system will be picking these things up. But again, Caroline will touch upon the issues that she's seen there from her side.
Thanks, Kim. So again, as Kim's experience, been working with employers since the legislation was introduced, spent a lot of time trying to prep employers for this, explaining how complicated it would be. And then the evidence is quite telling when we are working with employers since they have staged for auto enrolment. So just sort of lift some of the common sort of problems, issues that we see. No particular order really. Postponement letters not being issued. So quite often we can see that an employer, when they've staged, they've issued postponement letters, and then they have an intention to continue to use postponement for new starters, but they haven't actually been issuing them with the correct postponement notice, thus invalidating the postponement period. We're also seeing no certification of the contribution basis on record. Mark will talk further about scheme certification and the contribution requirements around that later. And then quite commonly as well, payroll deductions not matching the intended contribution basis. So pensions now fall heavily into payroll, and if your payroll department isn't adequately prepared and understanding the legislation correctly and what the intention of the business was, and checking what the contributions are, these are where the mistakes happen. And if they started at staging date, they could continue for that up until now and need correcting for that period of time. We're also seeing issues with tax relief as well. So perhaps the way the pension should be applied to the employer hasn't been run through the correct way on payroll as well. So we're seeing that as a problem. And really continuity planning within payroll department as well. So somebody might have had a real good grasp of what the business was doing when you first staged for auto enrolment, but actually they've left now, been replaced, and actually if there wasn't quite the same procedures in place documented, then something might slip. Poor member communications generally, and record keeping, so that employer can really evidence what's gone on, what they've done and when. So a lot of this is supported by lack of training for payroll, HR and finance, and making sure that they're all working together so that they all understand each individual team's role within that. Again, with re-enrolment, so many employees are working through re-enrolment, so we can see errors with compliance date, with the dates. So there might be two different staging dates within a group of businesses, and that one of them might have been missed for re-enrolment. So we're seeing things like that, and the incorrect communications again at re-enrolment time. And then something else which Kim's already mentioned on, we're seeing workers, and particularly directors where they might have an executive pension plan or something like that. They may be in a non-qualifying scheme, and actually if the scheme is deemed as non-qualifying, they should have been automatically enrolled into the employer's auto enrolment scheme. So we are seeing issues with that as well. So I think now we'll just do our first quick poll. So if you're happy to fill this in, it's just really how confident are you, how you've dealt with auto-enrolment. Okay, and I'll now hand back to Kim to provide some more examples of actually when these issues start to come to the fore.
Thanks, Caroline. So where I'm seeing a lot of these issues arising, so I mentioned that there seems to be a significant amount of employers that actually don't know they've breached the automatic enrolment obligations, or when it actually comes to light, when they realise they breached it, is normally around restructuring and acquisitions. I do a lot of corporate support work, and like I said, a majority of those, when I'm doing the due diligence, it's very clear that the sellers haven't complied with automatic enrolment, and it's news to them when we go back to them and advise them. So where employees seem to be getting it wrong on restructuring acquisitions, I would say quite common is where we're doing business and assets. If there's been a cheaper transfer of employees, they've gone over to the new co, and then the employer of the new company has failed to assess these workers and put them in an automatic enrolment pension scheme, or they've decided to use postponement, failed to issue the postponement notice. Again, employers have put in a pension scheme, but it's just not a qualifying pension scheme that is required under automatic enrolment. I think you need to also think about your group structure of your business. I see more and more common now where there's various companies within the group structure. I applied with automatic enrolment for one of the subsidiary companies and failed to do it for the other subsidiary company. So again, and what you need to do as well is make sure you submit a separate declaration of compliance for each of those subsidiary companies, because they're classed in the Pensions Regulator's eyes as a separate employer. So that's just something, again, that I just need to flag up so that you're aware. The other well is if you're setting up a new company. So if you, we see this a lot with overseas employers, they set up a brand new company. Historically, when automatic enrolment was introduced in 2012, all employers received a staging date from the Pensions Regulator. That isn't the case now. What you actually get is what's known as a duty start date. Duty start date is the first day upon which you have an employee that you employed, and from that date is when your automatic enrolment obligations commence. So you need to make sure that you do assess your workforce, put them in a qualifying pension scheme, but you also need to make sure that you submit the declaration of compliance to the Pensions Regulator within 5 months. Again, we're seeing a lot of new companies getting this wrong because they're not getting as much guidance and information from the Pensions Regulator compared to those businesses that were receiving all the information when automatic enrolment was introduced in 2012. So there's just a few things. One of the things I would suggest, if you're looking to sell your business, it might be worth just doing a quick audit, making sure that everything is correct, you've dealt with automatic enrolment, because then otherwise there'll be a conversation that needs to be had in terms of how the breach is going to be rectified, whether that's pre or post completion. And again, if you're looking to acquire a business, I think you need to do very good due diligence, because actually, like I've said, especially if you're doing a share purchase, you are going to take on all the liabilities, and some of those liabilities may be paying backdated pension contributions, but also having to make a report to the Pensions Regulator and making sure that you're not going to be responsible for any fines that are imposed. So don't worry if you do identify a breach. I think it's fair to say we're seeing more and more of these. In the last 6 weeks, I've got 5 clients now that have approached me and they've got automatic enrolment breaches. It doesn't necessarily mean you're going to get a fine from the Pensions Regulator, so don't worry. What we always recommend is, firstly, self-report yourself to the Pensions Regulator sooner rather than later. The reason why I say that is that I'd recommend you go to the Pensions Regulator before maybe one of your employees or the pension provider whistleblows you to the Pensions Regulator. So self-report Pensions Regulator, tell them what's happened, tell them that you've investigated the breach, that the breach won't be occurring, how you're rectifying the breach, i.e. you're going to pay backdated contributions, and just reassure them it's not going to happen again. Also recommend you need to issue communications to the affected employees. So you need to tell them that there's been a breach, that you've notified the Pensions Regulator, and also how you're going to rectify that breach, how you're going to pay any backdated pension contributions required. Also, you probably worth in, I'm not an employment lawyer, but I would recommend that you investigate that if there are any employment issues. For instance, if you have paid pension contributions that are contrary to stated in the contract of employment, that could amount to a breach of contract. Again, that's probably something my employment colleagues see quite a lot of at the moment. So again, something for you to look at so that you don't have any employment law issues. And like I've said, put the employee back in the position they were previously, making sure that the employee pension contributions are backdated and the employer pension contributions are backdated if there are missing contributions. And again, Caroline's touched on this, and again, it's something that she sees more on her side is make sure that the breach doesn't occur again, and you need to identify how it's not going to put in steps in place. Is it going to be training? What is it that you need to do? And again, going back to the employment issues, when you're looking at that is, again, going back to the pension contributions is, there could be, in some cases, and we've seen this on a few occasions, there's been an unlawful deduction of wages. So again, something just to flag up, something to just to be aware of if you're undertaking an audit of your pension arrangements.
Thanks, Kim. So we thought we'd just share with you a few examples of when we've worked with employers and what we've identified. So I think this helps demonstrate that it affects all different sectors as well. So with this example, it's an employer, big or small as well, over 200 employees. And what we identified, it really did just have lack of adequate record keeping. There was no evidence of any communications that they had issued to staff. The documentation that we were using to issue was incorrect as well, and also the payroll basis, the contribution basis on payroll was incorrect. So there really wasn't any sort of continuity plan. Had been a change of personnel within the payroll department that created a number of these problems. So working with that employer in this example, they've got documented processes in place now, and they do have the compliant communications that they need. But quite importantly, they've also got a reminder about the key events in place so that they know what to do for the future, and a written contingency plan should the people that are involved in this actually move on and leave the business. And then even a larger employer, and in this example, some of this came about from actually the client identifying some of these anomalies, which was from looking at changing their payroll. So we quite often see if an employer is looking to change the payroll system or supplier that they're using, that they then start looking and checking and analysing what they're doing is right, and then some of these issues come to the fore. So with this one, they identified that actually 47 employees hadn't been enrolled over a period, and also that they'd had some of the contributions had been delayed. So the first thing that they did was establish a working party of the key people within the business to help rectify this, and then liaise with the regulator. So the outcome of that really, because they'd written it was quite clear, their communication with the regulator, setting out what the issues were and how this had gone wrong and what they were doing to make sure it doesn't happen again in the future, that the regulator acknowledged the non-compliance but confirmed that there would be no further actions to be taken. And then that will lead us on just in, we've got another quick poll for you.
Okay, so next poll, because we like to ask a lot of questions, it turns out, as pensioners. Have you reviewed your automatic enrolment proposition? So have you never reviewed it in the last 12 months, reviewed it in the last 1 to 3 years, or reviewed more than 3 years ago?
Okay, so when we've been working with employers, I think some of the sort of top tips that we can share with you today, we talked a lot about the problems, but really just some helpful things hopefully for you for the future. So really make sure all relevant areas of the business understand what they're doing. So all the various teams we talked about, HR, finance, payroll, make sure that they all understand and work together on this. And there's training provided to people, particularly new starters. Even if they've worked within payroll before, possibly there shouldn't be that sort of presumption that they will have the understanding of the pension legislation. And make sure they've got written procedures. Save copies of the letters, the communications that you're using with your employees, and also perform a periodic audit of your data and processes. So whilst you might feel that you're doing this right and you've tested your payroll and it's okay, make sure you test it again at another point in time. Take a snapshot of your employee population and just check that everything looks as it should for those. Maintain a schedule of the key dates, what you have to do and when. So when it is your re-enrolment date, when you will need to make sure you've submitted that declaration of compliance to the regulator, when you need to certify your scheme if you need to certify it. And then obviously take any errors and omissions seriously. Don't paper over any cracks. The cracks will get bigger and more expensive over time. So it's best to tackle these as soon as you can. Be clear and concise in any reporting to the Pensions Regulator, so that they know that you've really got a good understanding of what's going on. Don't always rush to report. Make sure you set it all out so you understand and then report to them so you've got all the facts there ready. And if you're not sure what to do, appoint external parties. There are people that can help you with this. And really importantly, employers should always whistleblow on themselves. So if you've made a mistake, make sure that you are working with that third party, the people that tell the regulator the mistake. Don't let it be an employee that approaches the regulator to tell them. It's much better for you to sort of get your house in order and let the regulator know what's going on. So what does an audit entail? So when we work with employers, we can look to help them with an audit of their auto-enrolment processes and what's going on. So these are examples of things to look at. So scheme quality, first of all, making sure that you're meeting the minimum quality requirements, so that you are actually, first of all, as a basis, adhering to the bare minimum of the legislation, that you've got your key documents and templates in place, so you've got records of anything that you've submitted to the regulator, so that, and all the statutory letters, the communications that you should be using, for example, postponement, if you're using that. Staging day, it's always important to look, and we will look with an employer actually, what did you do at staging day? What was the intention of your business organisation, and actually did you follow that through, and within that, which contribution basis did you use, and then did you certify, and have you continued to certify? So we look at that when we move into ongoing processes, making sure that that certification has continued throughout. We also then look towards future compliance. So again, looking at your future dates, re-enrolment, checking that the correct information has continued to be issued to employees. As I sort of cited that example, some employees do issue the postponement out when they first stage, but have forgotten to continue to do that, hadn't realised to continue to do it. And then if you've got other concerns, actually analysing your payroll. So if you know you've made mistakes and the contributions haven't been deducted in the right way, it's then actually working out what you did and comparing it against what you should have done. So when we do that, we work with a third party that actually does all that analysis, so we can see in full what happened for every single employee and what should have happened, and then compare. And then beyond that, there's actually the legal support as well. So making sure that you have helping you with liaising with the regulator, compliance processes. So just making sure that you've got everything right, so that it stands when you are liaising with the regulator, and also quite importantly your employees, so they have that comfort in what's gone wrong, but actually that you've made sure you put it right. So with that, I'll now hand over to Nigel.
Thanks, Caroline. Good morning, everybody. Mark and I are going to talk now a little bit, taking what Caroline and Kim have covered, about how this applies in the current strange situation we all find ourselves in, having gone from a medical crisis into what's surely going to become an economic crisis. And I'm actually going to start with John F. Kennedy. JFK, back in 1959, when he was a senator, said the Chinese used 2 brushstrokes to write the word crisis. One brushstroke stands for danger, the other for opportunity. And having said that, he then sparked 60 years worth of debate about whether he could actually read Chinese properly. The important point is, for many businesses, the medical crisis has created a lot of danger, especially around cash conservation. Some businesses see an opportunity around pensions and employee benefits to save further cash by taking actions which may have served them well in the past. So it's all about cost control. A lot of the approach that we're starting to see already, and we have seen concrete examples of this, could best be described as common sense. But what's actually common sense to employers outside of the kind of pensions industry can actually lead to employers being fined by the Pensions Regulator kind of going forward. So we're going to talk about some of the things that you can and can't do on a practical level. So one of the things that we're already starting to see are some of the actions that were taken in the credit crunch being repeated. And one of the most popular things that happened in the credit crunch was lots of employers said to their workforces, look, we've got a stark choice here. We're either going to have to make half of the workforce redundant or a third of the workforce redundant, or everyone can agree to give up their pension contribution, because the cost saving from that will mean that we can keep everybody employed for a period of time going forward. And at that point in time, that did work for a lot of employers. Unfortunately, back in 2008, 2009, the auto-enrolment regulations weren't in place. Employers who try and take that action today, whether they use a positive approach or a negative approach to it, can find themselves guilty of inducement activity, so inducing employees to opt out of their pension arrangement. They will be subject to a fine, and they can face employment tribunals from their employees. So negative inducement activity is that threat of redundancy. Positive kind of inducement activity could be saying to your employees, look, if you all give up your pension contributions, that means the employer doesn't have to make a pension contribution. We'll give you an extra benefit, albeit a bonus or something else, at a later point in time. Taking that road, that common sense approach, can lead to problems. Also, some employers will look at the amount that they're paying and think, well, maybe if we could just reduce the percentage that everybody's paying, we'll be okay. Again, it was an approach taken quite a lot in the credit crunch. Unfortunately, most schemes these days operate on the statutory minimums imposed by the auto-enrolment regulations. So the 5% employee, 3% employer. You can't reduce your contributions below that amount. Other employers have already reached the point, and we've started to see this, where they're just desperate to conserve cash within the business, and they just stop making the contribution for whatever reason. Sometimes it's as a result of people in payroll being furloughed, and directors trying to take over functions that they can't manage. Other times it's just running out of cash. So payments stop, and whilst there's a moratorium for a short period of time granted by the regulator, those payments still have to be made up. The Pensions Regulator's position, to contrast to JFK's position, is that nothing changes in either of these crises. Continuity continues all the way through. So all payment obligations are expected to be met by all employers, and employers are still expected to keep up with their record keeping activities, and to maintain, if this situation arises, any re-enrolment obligations, the statutory obligation every 3 years to put all of your opted out employees back into your scheme. The next issue that we're already starting to see are, in the rush to furlough, we saw lots of HR and payroll teams being furloughed ahead of the regulations being finalised, and especially the regulations about what would happen to pension contributions. We've also seen employers who've taken incorrect advice from other advisors and made mistakes in relation to the pensions contributions around furloughing. Again, as Caroline and Kim touched on, Don't leave those things to fester. They will need to deal with them as soon as you've got your teams back in place. And part of the reason for all of this is the whistleblowing. Again, as Kim and Caroline touched on, even if you think you can get away with it, your employees now have an option to go and whistleblow both to the Pensions Regulator, which could lead to a fine, and to the Pensions Ombudsman, which can refer things back to the Pensions Regulator. In addition, the Pensions Regulator works very closely with HMRC, and under its real-time reporting requirements, matters are being flagged up to the Pensions Regulator where there are sudden changes in PAYE and payroll deductions. Added to that, you've also got all of the pension providers who are also under a statutory obligation to whistleblow to the Pensions Regulator should an employer suddenly cease to make contributions for no good reason. I'll hand over to Mark.
Thanks, Nigel, and good morning, everyone. So at this point in time, you may be considering changes to your pension contributions. Many employers are at this stage in the pandemic. But before you do so, I'd like you to consider how widely appreciated your current pension plan may be. After all, if your pension scheme is appreciated by employees, they're going to notice and they're going to maybe feel negatively about any changes you might make. On the other hand, if your pension scheme is to some extent under the radar, then perhaps you could tinker or reduce pension contributions without having too much of a negative impact on your workforce. I'd like you to consider, first of all, how good your pension scheme is as well, because after all, if you're thinking about making changes to a pension scheme that's very good quality, then it may, after those changes, still be a good pension scheme. But if you're thinking about making changes to a pension scheme that isn't very good, and your employees perhaps know that it isn't very good, then any further reduction may well be a very negative impact. There's been a lot of focus since auto-enrolment on pension scheme charges. I think it's fair to say the regulator is highly focused on charges, and there's been a great deal of pressure on what might be seen as relatively expensive pension plans to reduce charges, certainly below the auto-enrolment charges cap. But I'd like to state that it's really not all about charges. By far the biggest contributor to a good pension by the time someone retires is the amount of money that's being paid in. You know, it's an input and output situation. So if you're not paying much in, you won't get much out. If you're paying a decent contribution, that makes a huge difference. Secondly, in our opinion, as pension consultants, will be the investment performance. So you could have a very low cost pension plan with fantastic investment performance and low contributions that won't do very well. Conversely, you could have high contributions and low investment returns, and you still won't have a very good output. So it's about the blend of lots of these different features. So a very good place for you to start before you make any changes is to review the scheme, get a quality assessment from somebody who can benchmark that for you, and give you a report before you make any significant changes to it going forward. Thanks, Nigel.
Thanks, Mark. Before we go through the potential solutions that may lay out there for everybody, we've got another quick poll that we'd just like everybody to respond to, and this is about considering future changes to your auto-enrolment scheme. 3 basic responses: yes, we are considering a change; no, we're happy to keep the scheme as it is; or unsure, haven't really thought about it. Thank you. Okay, so if at this point as a business you're feeling a little like you're in between the proverbial rock and a hard place, with the pensions regulator saying nothing should change, and at the same time the other side of the coin is your business, your directors are looking at you as HR and or payroll and saying we need to find some savings somewhere. Cash conservation is critical for the business at this current point in time. Are there any things that you can do that won't get you into hot water with the regulator? And in certain circumstances there are. So Mark and I are going to talk through some of these things. There's no one-size-fits-all solution for every business, and it's really looking at what works for your individual business. So the first thing is to look at those employers who have contribution structures more generous than the current statutory minimums. You can actually reduce those contributions down to statutory minimum levels, but doing this doesn't come without additional requirements. So under both pensions legislation and employment legislation, depending on how your contracts of employment are structured, you may well have statutory obligations to undertake consultations with your employees about the reduction in contributions. And linked to that, really, before you go down that route, is to think about how this reduction in contributions is going to work. Is this a long-term reduction, or is this just for a short term to get the business through a very difficult period? If your scheme's set up under trust deed and rules as opposed to a contract with an insurance company, you may need to consider amending the scheme rules. If that's the case, you may need to consider engaging with the scheme trustees and discussing with them how this is going to work. So there are planning issues that you need to think about before deciding to go ahead and make that change. And it always pays in these situations to think well ahead of where the rest of the business needs you to make those changes really critically. Trying to leave this to the last minute and do it in a rushed manner could also lead to problems going forward. I think the next area is probably around salary sacrifice arrangements. And I find this a really strange situation because throughout pretty much all of my career, I said around auto-enrolment, salary sacrifice is pretty much a no-brainer. You generate both an NI saving for the employer and an NI saving for most employees by having this in place. But Mark, I mean, tell me what you think. I think the current situation around furloughing has thrown up some question marks for employers about the efficacy of having salary sacrifice arrangements.
It has indeed, Nigel. Yes, I think if you have a salary sacrifice arrangement in place and you have furloughed a significant number of employees, the complications of that might well mean that you haven't necessarily paid the right contributions during furlough. And also, I think I'd have to say that certain salary sacrifice arrangements can be complicated and even inefficient where there are a lot of low-paid workers. But on balance, I'd agree with you, Nigel, it is still something of a no-brainer. The complications can be dealt with by understanding salary sacrifice and how it works, and with good communications with employees as well. So we would still say the generous national insurance savings for companies and for their workers mean that it is still something of a no-brainer for the majority of companies anyway.
Thanks, Mark. So this is one of those areas where employers may think about whether they have salary sacrifice or not. Certainly HMRC around furloughing have allowed employees to treat this as a lifestyle event and opt out of salary sacrifice because of the issues that it's raised. Another area which most employers overlook is the basis of certification. It is possible to change the basis on which your scheme is currently certified, and there may be opportunities there for cost savings, especially if your definition of pensionable earnings in your pension arrangement is higher than the statutory definitions. Again, there are other factors you need to consider as part of that process. So thinking about consultation, both on a pensions legislative basis and also employment. You may need to think about amending the scheme rules. Again, that may involve having a discussion with your scheme trustees. And key to all of this, as Mark sort of touched on, is effective communications with employees about these changes. How long is this going to take place? How is this going to be structured? What's the outcome going to be for an employee? We have seen situations where employers have changed the basis of certification, and employers have actually had more money in their take-home wage packet as a result of it, while still not losing out in terms of a decent pension contribution. So there are opportunities there to deal with certification, and I think that's something, Mark, that you probably look at quite a bit in terms of the work that you do.
Yes, we do indeed, Nigel. Yes, thanks. So Caroline and Nigel have both mentioned certification and the different bases that employers can choose in terms of workplace pensions. And on the next slide, Tom, if you could just advance that for me, please. The contribution structure that you had before auto-enrolment, if you had a pension scheme pre-auto-enrolment, very probably your pensionable earnings definition is basic salary. That was really common. If you then went into auto-enrolment with the same pension plan, you probably kept the same earnings definition. However, for employers setting up a brand new pension plan for auto-enrolment, a new definition of qualifying earnings came in at that time. You didn't have to choose it, but if you didn't use qualifying earnings, you would have had to certify the basis you were using. So certification is an employer deciding to use a pensionable earnings definition other than qualifying earnings. So qualifying earnings is a pension contribution calculated on the same level of earnings that national insurance is calculated on, middle band earnings for those in the know. That generally means for low to medium paid workers, a lower pension contribution basis for both the employer and for the employee. So changing to that, I would describe this as being potentially under the radar. If you were looking to reduce to the qualifying earnings, the minimum statutory basis for pension contributions, we wouldn't expect many employees to understand the difference, and a cynic might suggest that that might be widely accepted. However, if you're looking to change the percentage contribution that you pay from, let's say, 5% or 4% down to the minimum of 3%, that's a headline. Employees do understand the percentage that their employer pays, in my experience. And so that would be perhaps more controversial in the workplace and more difficult to arrange. It is a complicated subject. The earnings basis within auto-enrolment schemes is one of the more complicated aspects of the rules. So if it would help for one of us to explain that to you offline, we're more than happy to do so. So if we could just have another poll, we'd like to ask you whether you're looking, as a result of the pandemic, to restructure or make significant changes to your employee benefits in the near future. You could just have a look at that for us in the next few seconds, please. Thank you. And we'd now like just to let you know about some future webinars that we're planning based around some of the topics that we've talked about today. So more detail is coming on a salary sacrifice webinar, which we'll be running next. And we can go into much more detail than we did today about that subject. Following that, we'll also talk about furloughing. We'll be coming to the end of furlough soon. And we would like to look back at how employers have treated pensions and other employee benefits during furlough and offer you some advice around those subjects. We'll then look at risk benefits or insured employee benefits in a future webinar. These are benefits such as income protection, death in service cover, and private medical insurance. And there are some employment law and financial implications of getting that either right or wrong. So we'd like to talk to you about that. And then further down the line, later in the summer, we'd like to talk to you about benefits harmonization. Many companies have acquired other businesses, and it's really difficult to try and harmonize benefits across different business companies within a group. So we'd like to talk to you about those subjects as well. So we look forward to speaking to you in future. We hope you'll join us again. And now I'd like to hand over to Kim for the question and answers session. Thanks, Kim.
Hi, thanks, Mark. So we've had quite a few questions which have been submitted throughout the webinar. So I'm just going to go through some of these. I think we've got 15 minutes or so before the webinar concludes, so I'll try and get through as many as I can. But for anybody who submitted a question which we haven't been able to answer, we'll arrange to send you an email with our response. And also we're happy to address any queries you might have that you want to discuss offline. So the first question we've got from Sharon. I think this is probably one for Mark and Nigel. What do you need to be aware of if you want to change your pension scheme?
Shall I start, Mark?
Yeah, why not? Thanks, Nigel.
Okay. So I would start with two things. I'd start with the rules of the scheme and the contractual position of your employees under that scheme, because they will drive what you have to do. If your contract's silent, then you only have to deal with pensions consultation requirements. If you've got obligations both in your rules and in your contracts of employment, you're going to have to deal with both sides of that. But I'd always start with something like this, with having a clear idea of what it is you want to achieve as a result of any change. That's always going to be the starting point, and that will then drive what you need to do in the other areas, and also help to develop your communications plan and how you're going to communicate this, because in all of these change type situations, especially where the change is in quite a stressful type of environment, having clear and effective communications with your employees is really critical.
Yeah, just to add to that, Nigel, I think I'd agree with everything Nigel said. But in addition, Sharon, I think the questions you're asking within the business will include a reason, that you will have a reason why you want to change the pension scheme. So is it the type of scheme that's unsuitable? Is it the provider of the pension scheme that's not delivering on their service standards? So there might be some service issues or investment performance issues within the pension plan that aren't being met. So that's a relatively easy thing for a pension consultant to consider with you. So yeah, I hope that helps.
Thanks, Nigel. So the next question we've got is, what kind of fine are we looking at if we've made an automatic enrolment breach? I'm happy to pick this one up. So what tends to happen, and what we found, is if you go to the Pensions Regulator and self-report, and you tell them you're rectifying the breach and the steps you're taking, and that it won't happen again, we found that the Pensions Regulator doesn't issue a fine. They'll more often than not correspond with you and tell you that they're happy with what you're proposing going forward. Normally we see that where fines are imposed by the Pensions Regulator is where the Pensions Regulator is notified of an automatic enrolment breach, either by being the company's been whistleblown by the pension provider, or it's been whistleblown by an employee, and at that point the Pensions Regulator will step in. If that occurs and the Pensions Regulator gets in touch, you're looking at probably a £400 fixed fine. Again, it's going to depend on what the breach is. Willful non-compliance sometimes has a rather heftier fine, but you're normally looking at £400 fine. If you fail to pay that, and also if you fail to rectify the breach to the Pensions Regulator's satisfaction, then you're looking at anything, an escalating daily penalty of anything from £50 to £10,000. So really, as our recommendation is, as soon as you know that there's a breach, just self-report yourself to the Pensions Regulator. So I've got another question here. Okay, this is from Violetta, and this I think might be one for you, Caroline. We have enrolled everyone under the Tier 2 in the past. However, under the company's pension scheme, the definition of pensionable earnings is basic pay. It has recently come to the company's attention that the 85% threshold under the Tier 2 may not be satisfied. We can't locate the original documents when the pension scheme was set up. Where will be the best place to look for these, and what are the correct steps that we need to take?
Thanks, Kim. So in terms of where to look for those, I think if you worked with an advisor at the time, they might have some copies of documentation to help you out. And then if not, it's really looking back through your original documentation. If you can't find anything within the organisation, it's going to be quite hard to find something really to document that. So I would say look and just see what you did in terms of reporting to the regulator at outset, and actually working with another advisor. If you worked with an advisor, see if they've got copies if you can't find anything in the organisation. If this is the way it's been the general assumption that this is what you've been doing, then it's fair to say that that was the intention of the business. Actually, how to correct it if you haven't actually done it correctly is actually looking back. It really is going back and looking and assessing through the contributions that have been deducted and comparing them to really what should have been deducted as the minimum, and taking steps to put that right with the employees. So there's quite a bit of work really in terms of looking back and assessing and working through, and you might find that it's just a handful of employees where there's a key issue, and addressing those and certain pay elements and things like that that need rectifying, and making sure that they fall under the contribution basis to make sure you're getting towards that 85% threshold. So it's hard to answer it particularly concisely but on this call, but I hope that helps a little.
Thanks, Caroline. So we've got another couple of questions here from one of the attendees. Is there every 3 years of the enrolment from the day the employees opt out, or is it every 3 years from the organisation? So I'm happy to pick that one up. So in terms of your re-enrolment obligations, it's from your staging dates. Now, you have, there's a little bit of flexibility there. So it can be either 3 years prior to your re-enrolment date, that's 3 months before the third anniversary, or it can be 3 months after. And you've also need to be aware that where employees have opted out, you don't need to re-enroll any employees who have opted out within the last 12 months. So in summary, it's the 3-year anniversary of your staging dates. In terms of your next question, which I think this might be one for you, Caroline, every 3 years, we need to do re-enrolments for opted out employees. Do we also need to increase the pension contributions to 8% again for employees who are currently on 0% as they were too late with opting out?
Okay, thanks, Kim. I think to answer that, the point, so yeah, to re-enroll employees every 3 years, if the legislation, the starting point of the legislation is to assess and re-enroll anybody who is not in the pension scheme or has reduced their pension contribution below the requirement. So if somebody has chosen to opt out at outset, or actually then chosen to leave the pension scheme within that period, you'd have to enrol them, or actually chosen to reduce their pension contributions, so they're paying something in but they're not meeting the minimum requirement to also get the employer contribution. If I give an example of, if we say that the minimum requirement on the percentage basis meant that the employee had to pay 50 and the pounds per month and the employer was paying 70 pounds per month, if for some reason the employee couldn't afford that 50 but they asked to stay in and just pay 30 pounds a month, you would still need to assess and enroll that, re-enroll that employee back onto that full contribution basis. So it's a little tedious. They'd have to go through the process of opting, sort of reducing it down again, and you'd catch them again every 3 years.
Thanks, Caroline. Another question, I think for you and I, Caroline. It is clear that an employer needs to rectify current workers' position in terms of any errors spotted, and also to ensure they address processes to ensure that these do not occur again going forward, and then self-report to the Pensions Regulator. What is the panel's experience of the Pensions Regulator's instructions as regards to errors with ex-workers? Have you seen the employer be instructed to track down ex-workers to correct their position also? I think, Caroline, both you and I have had experience of this. So, Caroline, if you want to start first.
Yes, quite surprisingly, we've had the response on a number of occasions from the regulator that ex-employees, former employees, no longer you no longer have duties applying to those. So you don't have to track them down and make good their level of contributions. It was a bit of a shock to us, and we've tested it and questioned it a few times, and when I've explained it to employees, they've also been quite surprised by it. But I think this is to do with the auto-enrolment legislation, but there's probably an employment piece behind that, as employment law piece behind that as well, in really that actually, what if the employee realised and then comes to you in the future demanding for those pension contributions that you possibly didn't make, or the correct amount. So it's really important that you've got the record keeping for those ex-employees, so you know, and you've calculated, so you've got a clear documentation process somewhere. There's a clear file that says actually what happened and what needs to be done for those employees. But with the regulator, I haven't seen a case yet where they've asked that anything is made good. It doesn't mean to assume that that's always the stance, and we would always just verify with the regulator in each scenario.
Yeah, thanks, Caroline. I completely agree. When you are going to the Pensions Regulator, how we do, we tell the Pensions Regulator what we're proposing to do, and we request that they come back and let us know if they're going to take any further action. And then, like Caroline says, we've done it on more than one occasion, saying that in most cases, employees are not proposing to trace those individuals for the costs incurred in doing so. But again, I agree with Caroline from an employment law perspective. That is something that you will need to consider as well going forward. So we've got another question. I think, Caroline, this is probably one for you and I again. Apologies, Nigel and Mark. This is from Hannah. Do we need to notify employees of re-enrolment when it happens? Caroline, do you want to pick that up from the comms point of view?
Yeah, so good practice, we would say, is to communicate to employees ahead of the re-enrolment to make sure that they're aware. So anybody not in the pension scheme or who has opted out ahead of the sort of using the 12-month window prior to re-enrolment date, good practice is to write to those employees to make sure that they're aware that re-enrolment is coming and what you propose to do about it. Obviously then when it comes to re-enrolment, there does need to be a statutory level of communication to explain that they have been re-enrolled into the pension scheme, because employees do need to be notified how they're in a scheme and who the scheme is with, and that they can opt out again. So you do need to make sure that employees are communicated to.
Okay, another question from Natasha, one for Mark and Nigel. Given how precarious life is for businesses, is the Pensions Regulator going to focus on SMEs who do actually get it wrong going forward, or historically?
I don't think in particular, Kim, that SMEs are under the radar any more than any other business. I think any employer that gets it wrong is potentially going to hear from the regulator if they're caught or whistleblowed about that problem. So I'm not aware of any particular focus on SMEs from the regulator, but all employers should be careful to comply as best they can.
I think what we're seeing is, and I agree with what Mark's saying, it is all employers. We're already seeing situations where insolvency practitioners have been appointed to businesses, where businesses disengaged from making ongoing pension contributions, and the regulator has and will continue to investigate historic absences of pension contributions. So it is looking at all businesses and to ensure that contributions are being made, and it will stroll its way back through whatever has happened around those schemes. And in some cases, we've seen the regulator pursue insolvency practitioners because they've got the situation wrong, where there's been an administration, for example. In other cases, they've gone back and pursued the directors where they failed to make contributions prior to the business entering the insolvency process. So there is a focus on all businesses making contributions on an ongoing basis.
Thanks, Nigel. Thanks, Mark. So I'll just got time, I think, just for a couple more quick questions. A number of people are asking if they'll get a copy of the recording after this session. I think, Tom, correct me if I'm wrong, I think yes, the answer is you will get a follow-up email with a link to this session. If you need anything further, by all means, get in touch. So the last question, and this is probably more for Caroline and I, which has come from Stephen. How quickly do we need to address a breach? Because with lockdown and with everything that's going on at the moment for businesses, it's not on everybody's agenda. And that came from Stephen. Stephen, our view is always that you need to rectify the breach ASAP, because I don't want to say you want to get in there before any whistleblowing by employees or pension providers, but like I said earlier, want to self-report to the regulator as soon as possible, and then tell them what you're doing to avoid any fines being imposed. But I appreciate at the moment businesses are going through a lot of things, and automatic enrolment is certainly not high on the agenda. But I think, as Caroline mentioned, the quicker, the longer you leave it, the bigger the problem becomes. So I'd always say is to assist a business, get specialist advice. We're finding that there are a number of specialists out there that are trying to advise on automatic enrolment and getting it wrong. So make sure you get specific pension specialists. And Caroline, is there anything you'd like to add from your point of view?
Yeah, just to obviously echo the comments you've made, Kim, as well. And I think sometimes it's, as I emphasised earlier in the presentation, it was about actually making sure that you've got clear and concise information to deliver to the regulator. But the starting point could be a notification to the regulator to say, we've identified some irregularities or we've identified some issues. We're actually now working to understand what these are and we'll report further to you, just so there's some level of communication to them, so that if somebody else approaches them, an employee, for example, before you do, at least you've actually taken that initial step, and start working on it as quickly as possible. Even if you've done that, don't just then park it and think, oh, we've let them know, we'll start looking at this in 2 months' time. It's to start looking as quickly as possible. And if you haven't got the time or the capacity or the understanding within the organisation, there are specialists like ourselves here today that can help you with that and move it on as quickly as we can for you.
Thanks, Caroline. So with that, I think we're right on time. I'll just hand you over to Tom, and that's it from Caroline, Nigel, Mark and myself.
Thanks very much, Kim. Just to let you all know that we'll send the recordings out next week. If you've got any more questions for the team, the contact details are on the page on the screen now for you. Thanks very much for attending, and have a great weekend. Thanks very much.